Okay, picture this. It's early 2026. The absolute frenzy that kicked off with ChatGPT, well, it's pretty much gone. And in its place is this deep collective anxiety about the future of AI. You can feel it across the entire tech world. Everyone's holding their breath, asking the same thing. What is going on here?
And that really is the billion-dollar question, isn't it? Is this just another dot-com bust, version 2.0? You know, we've all seen this kind of hype train before, and a lot of smart people are worried we're just about to fly off the same cliff we did back in 2000. But what if? What if it's not a repeat? What if it's something different entirely?
And here's the core idea we're going to unpack. This isn't a simple copy-paste of the past. Think of it more like a rhyme. What we're seeing today is being called a construction bubble. We're not just throwing money at flimsy, revenue-less startups like back in the day. No, this time we're building. We are massively overbuilding the actual infrastructure, the digital highways for AI, and that is a world of difference from the valuation bubble of the dot-com era.
Right, so to really get a handle on where we are now, we have to rewind just a little bit. Remember the pure magic of first using ChatGPT? That feeling kicked off a legitimate gold rush. But now, the shine is wearing off. That initial excitement has been replaced by some serious skepticism, mostly because companies are finding it incredibly hard to turn that magic into actual money.
This is exactly where we are today. We are deep in the trough of disillusionment. The phase where we all thought AI was magical and could do anything? Yeah, that's over. The market has just slammed face first into a wall of reality. Why? Because taking these incredible tools and actually plunging them into the messy, complicated guts of a real business, well, it turns out that's insanely hard. It's super expensive, and boy, is it slow.
But this isn't just about a hype cycle, boom and bust. The whole economic landscape is totally different than it was in 2000. The kind of money that's funding this boom and the kinds of problems it's creating, they're not the same at all. And that difference changes everything.
Let's break it down. Back in 2000, the bubble popped because the Federal Reserve cranked up interest rates, creating a liquidity shock that basically cut off the oxygen for cash-burning startups. Today, it's a capital efficiency shock. See, we're just coming out of this bizarre, decade-long era of nearly zero interest rates. They call it ZIRP. Money was basically free. Now that it's not, investors are banging on the table demanding actual profits, not just growth at all costs.
And what's wild is, even though the peak interest rate today is way lower than it was back in 2000, the shock to the system feels just as intense. When you go from practically free money to a rate of 3.5%, it feels like someone just turned off the fire hose of easy cash that was fueling this whole AI boom.
And this brings us to probably the biggest, most important structural difference. The dot-com bubble was all about these super fragile companies, think Pets.com, that were just incinerating cash. Today, the AI race is being run by the Magnificent Seven. These are giants, Microsoft, Google, Amazon, with trillions of dollars on their balance sheets. They have what some are calling a balance sheet firewall. So yeah, are we in for a painful correction? Absolutely. But a complete systemic meltdown like the Nasdaq's 78% freefall? Probably not.
Now, if you want to understand the sheer scale of this construction bubble, just look at this number. The top 4 cloud companies alone are on track to spend almost $500 billion on AI infrastructure. Just this year, that is more than the entire economy of Denmark. The spending is so much bigger and so much more concentrated than anything we ever saw during the dot-com build-out. It's just staggering.
Every single construction bubble in history ends the same way, with a glut, a massive oversupply of whatever it was people were frantically building. In 2000, that thing was fiber optic cable. In 2026, it's silicon. It's the chips themselves.
And this comparison right here, this is the absolute key to understanding why this time is different. The fiber they laid in 2000 was a passive asset. It had a 25-year lifespan. It could literally just sit in the ground, dark, until demand finally caught up years later. But today's GPUs, they are active silicon. They become obsolete in just 3 to 5 years. This means those hundreds of billions of dollars being spent have to generate a return on investment right now. There's a ticking clock on every single one of those chips, and it is ticking very, very loudly.
And guess what? The glut is already here. It's not a future problem. A year ago, NVIDIA's H100 chips were basically the most sought-after things on the planet. You couldn't get them. Today, the price to rent one has completely collapsed. We're talking more than 50% off their peak. It's the classic boom and bust cycle. Shortage leads to overinvestment, which leads to oversupply.
And it's hitting the hardware market hard.
So in this kind of environment, who actually makes it out alive and who gets completely wiped out? Let's take a look at the key players and see how they stack up against their dot-com era ghosts.
This is the comparison you hear everywhere. Cisco was the undisputed king of the dot-com era, right? They sold the picks and shovels, the routers that built the internet. Then its stock cratered by 80% when the bubble popped. So is NVIDIA just headed for the same fate?
Well, the argument is a little more complex than that. On the one hand, the bulls say NVIDIA is nothing like Cisco. Their customers are those cash-rich giants, not flimsy startups, and their CUDA software is this incredible sticky moat that's hard to escape. But the bear case is pretty compelling, too. It says NVIDIA isn't the new Cisco, it's the new Sun Microsystems. Sun was dominant, but they got absolutely crushed by cheaper, good-enough alternatives. And that could happen to NVIDIA as the market shifts from training these giant AI models to just running them for users, a process called inference. And that's exactly where Google's and Amazon's custom, cheaper chips could really start to hurt them. Now, if you're looking for the clear losers, here they are. The so-called AI wrappers. These are the thin apps built on top of models from OpenAI or Google. They are the pets.coms of this cycle, no question. You've got companies like Jasper AI, who are finding out their whole product is just a feature that the big guys can add in an afternoon. You've got Stability AI, who prove that giving away your multi-billion-dollar tech for free is, shockingly, a terrible business model. And then you have the hardware flops like the Humane Pin and the Rabbit R1, which showed us all that the world is just not ready for a post-smartphone life yet.
So all of this, the glut, the failed startups, the disappointed CEOs, it's all leading to something called the Great AI Filter. It's this incredibly harsh reality check that's happening inside big corporations where all that hype is finally getting tossed out the window in favor of a simple demand: show me the results.
Get ready for this number because it is staggering. A recent MIT study found that a full 95% of corporate AI pilot programs fail to ever make it into full production. 95%. They call it pilot purgatory, and it's not hard to see why. The models hallucinate, they're wildly expensive to run, and the data security issues are a nightmare. A cool demo is one thing, but a reliable, business-critical application? That's another thing entirely.
And here's the direct result of that purgatory. A massive PwC survey found that more than half of all CEOs have seen zero return on their AI investments. No new revenue, no cost savings, nothing. So what happens next is predictable: a massive spending freeze. The era of the blank check for any AI experiment is officially over. The CFOs are in charge now, and they want to see a clear path to profit.
And in the private startup world, this is creating a sort of hidden crash. We now have hundreds of what are being called zombie unicorns. These are companies that raise tons of cash at these insane sky-high valuations, but are now basically insolvent. They're not technically dead, but they're not really alive either. They're just shuffling along with no realistic path to a profitable future for their founders, their employees, or their investors.
So, where do we possibly go from here? Well, 2026 is being called the indigestion phase. The whole market just needs time to digest this massive glut of chips and all these failed projects. But there's good news here. This pain is what sets the stage for the real revolution. All this cheap computing power from the glut is going to make a whole new category of agentic AI possible by 2027. These are systems that can actually do things in the world for you, not just write an email or generate a picture.
And that really leaves us with this final, powerful thought. We've built the infrastructure, it's huge, it was ridiculously expensive, and right now it's sitting underutilized. But it's there. So this isn't the end of the AI age, it's just the end of the beginning. The dot-com crash didn't kill the internet, did it? It purified it. It cleared out all the junk and paved the way for the real giants, the Googles and the Facebooks. And the big question for all of us now is, who is going to rise from the ashes of this AI correction?